everybody, it's Wednesday, so let's chat. This is Kanan Chandran. I'm the publisher of stormasia.com, and this is our regular series of discussions called the WED Web Chat. It's a lunchtime 45-minute session where we will talk about all sorts of issues. And I think given what's been going on in the world these past few months and a year and a bit, there's a lot of uncertainty about what lies ahead. Well, I think sometimes though you might want to try and manage your future to some extent, which is why today's session is on looking at how you can best plan your estate, right? Your assets, do you have a will in place, your CPF, your property, your insurance policies, all these things are there. And when you do pass on, would they pass on to the right people? Would they be doing the things you wanted them to do when you first thought of doing it, right? And for today's session, we have three gentlemen in the house, in the room, and they'll be talking about their areas of experience and expertise with regard to managing your estate. So we've got Ethan Lim, who's a Senior Relationship Manager at HP Wealth Management. Ethan graduated with a degree in banking and finance, and then he joined Credit Suisse, handling the wealth of ultra-high net worth families across Southeast Asia. And now with HP Wealth Management, he runs two family offices and is looking after their investments in public and private markets, establishing a proper governance structure and looking into their philanthropic ambitions. Welcome, Ethan.
Hi, everybody, and good afternoon.
We've also got Chiwi, who's the CEO of PreceptsGroup. Chiwi was in legal practice before being appointed as Chief Executive of the British and Malayan Trustees Limited. It's the oldest trust company in Singapore. He joined Rockwills in a similar capacity in 2008, before it was bought out and renamed PreceptsGroup. That was in 2019. Welcome, Chiwi.
Yeah, hello everyone, and good afternoon. Thank you, Kanan, for inviting me.
You're welcome. And we've got Swee Yong, the CEO of International Property Advisor. Swee Yong has been on a few panels with us and has always brought a lot of insight into the discussions. Swee Yong runs his own real estate business. He lectures on the topic. He has written 6 books about it and likes to share his opinions on a variety of topics in various media. And it was the last chapter in his latest book, The Future of Real Estate, which prompted this discussion. I don't think you can see that. Yeah, okay. So with that in place, and we know who's who and what they're interested in, what they're involved in, let me ask this question to get this session off the ground. How young or old do you need to be to start planning your estate? Can you be too old or can you be too young? Too old would be if you kick the bucket, I guess, but can you be too young?
I think too old is when dementia starts to get in and whatever documents you sign could be challenged as whether they are valid or whether you were signing them under influence of too much drugs that has been prescribed to you. Right. Too young, definitely, because if you are going through the process of distributing wealth, what happens if you accumulated a lot more wealth later? Or what happens if the laws change such that whatever you want to pass on to your loved ones, you can't pass them on based on what you wish you had written down 10 years ago. So there would be appropriate times, and having done the first will and the first power of attorney, you would consider revising them regularly to make sure that they are still valid and that your portfolio hasn't really changed a lot.
Yeah, from my own experience, I've seen people of all ages. And speaking of even young people, you know, nowadays, you have all these young entrepreneurs who have amassed a lot of money, even in their 20s. And we've also seen people who are on the verge of the last days looking to do up their will. I've even gone to the hospitals to take instructions. And on one occasion, after getting the will drawn up, the person passed away in like 2 days after that. So never too young. Better not leave it until the later stages. That's really quite, will get too emotional, and you know, the thoughts may not be so well thought out at the time.
Anybody starts thinking about what's going to happen to my assets when I'm not around. When that thought comes to mind in the middle of the night, you know you need to start thinking about succession planning. I think that's the best guideline for me.
Okay. So yours would be a case of continuity, right, Ethan, in terms of keeping the business going. So from the perspective of the individual, though, I mean, I know there are some people who do not want to bequeath their stuff to anybody. They would rather put it into some other play because they feel their children should make their own money and find their way. What you're doing, however, is enabling the next generation, giving them more than a leg up in life. What are the schools of thought on that, and how do you feel about that?
Now, for my case, because I run a family office, and these are first generation wealth creators, and therefore most of the Asian families believe in passing on their wealth to the next generation. And therefore, there's always this adage whereby the wealth never crosses 3 generations. So many of these wealthy Asian families start thinking about how to preserve their legacy. It used to be having simple wills would suffice, but as families' wealth increase, they have assets globally, or they have a little bit more complicated assets. That's where they start to seek advice to set up a trust. That's where Chiwi's specialty is. But for family office, it's even a little bit more complicated because their assets could be complex. They want flexibility on the kind of assets that they can hold, they can distribute to the second, third, fourth generation. Increasingly, they are inquiring about private trust companies, which is an even more, I would say, more customized kind of succession planning. But nonetheless, I see the increasing trend of not only the first generation requiring succession planning, it is the second generation is asking their parents, hey, what's going to happen to your money when you're not around? So the taboo conversation is getting less and less. It's beginning to be a very open conversation. So I think this topic today is a very apt topic, especially with the COVID pandemic. All of us are starting to think about how we pass on our assets to our subsequent generations.
On that point, I wanted to add that there are children who see that the parents have 5 real estate assets, maybe 2 are overseas, and the children know that they are in no mind or interest to want to manage those when handed down to them. So in fact, if the family is willing to have that conversation, and you know that maybe your child is musically inclined and just wants to practice his trade and doesn't really care about having a side income from collecting rentals, especially not collecting rentals from that apartment in Kensington in London, right? So I think having that conversation is great, and not we have made the wealth, but the next generation may not appreciate what we are transferring. We thought that we are transferring wealth to them. They think that they are inheriting trouble.
Increasingly, I'm not just focusing on the transfer of wealth, but more in terms of preserving the family money, which means that if you are the next generational beneficiaries, you are for the time being just the stewards of the family money. So in other words, we also discuss concepts which are of strong appeal today, like when you have a trust fund, that becomes like your family bank. And I think that conjures the idea that the money is for the family, that you can use the money, but you have to put it back. So if you take out money to go and buy a property, or it helps you to make the down payment for a purchase of your own residential property, at some stage, you put back the money because that is the family money, so that over long periods of time, the family money stays the course, and it's available to yet another generation down the road.
What would complicate this issue? Would property in many parts of the world, broken marriage, children from different spouses, what are the things that complicate your
the life journey is complex, and everybody's all the children, they have different personalities and dispositions towards how they view money. Some will be spendthrift, some will be very careful with money. So trust structure is certainly a very useful instrument to ring fence the assets. And the beauty of a trust is that it can keep intact the shares of the family business 100%. So if the founder builds up a successful business, he could have the trust hold the family shares instead of what I describe as the fragmentation of family companies. When you start to give away your company shares to your children, there's going to be dilution, and over time, everybody gets small diluted interest, and they become disinterested because of the small shares that they hold. But if you can keep intact the family wealth and transit it from one generation to the next, the value can be preserved. And like what I said, if you are the children, you have the ideas of stewardship, meaning that you are, for the time being, just looking after the family money.
With trusts, what's the duration for them? What are the mechanics of the trust?
Well, trusts have been around for the longest time under the English law. Singapore adopted the English law. So in my own experience, I've also encountered trusts that have run for many, many decades. Current law is that a trust could last for up to 100 years, which means that at the end of the period, the capital of the trust would need to be distributed out to whoever would be the ultimate beneficiaries. But on a world scale, there are some jurisdictions where they have abolished the need for trust to have a perpetuity period. In other words, Singapore law could be reformed one day to allow for trust to go on forever. Just like companies, if you set up a company, it has a perpetual existence so long as it is solvent. So the same goes for trust, possibly down the road.
So these changes of the law also applies to changes in tax codes. Inheritance tax is one example, but where it relates to real estate, there are all these buyer stamp duty, seller stamp duty, ABSD, and if the real estate that you're transferring to your children, because who doesn't want to make a bit more money, right? So even the richest guys, sometimes you see that their bungalows have got a loan on it, but at the point of transfer, because we don't know when we will leave, right? If the estate, the real estate moves with debt on it, and then you have got things to consider around total debt service ratio, because there's a home loan there, and your child happens to be in the middle of his Harvard MBA and he has got no income, and then he's receiving a $10 million house that has got a $3 million outstanding mortgage. So these are some of the complications and issues. So think through all the steps one by one.
Gone are the days when you welcome the inheritance of any property passed on by your parents. We would like to think that when they do give you some real estate, it is unencumbered. But one of the issues that has caused is that if you happen to take a 20% inheritance of the family home left by your parents, that might cause you a problem when you go and buy your next property because of the way the ABSD rules work, right? Under the rules, even if you own a 20% fractional interest that you have inherited, that becomes a one count for purposes of working out your status when you buy your next residential property. And that could pose a problem, because suddenly you end up having to pay a 7% additional buyer's stamp duty. And when you're a young person, that's not going to be a very good way to start perhaps a marriage, when you go with your new wife and want to buy your first property for occupation. So these are some of the things that could be potential pitfalls in the will making. So sometimes we would tell parents who wish to simply give away the shares of the family home to their few children, right? We will ask them, would any of your children be looking to buy their own property, at some stage? There you are.
And you can't transfer a landed house to a child who has just last year gotten his Australian citizenship.
Yeah, the rules are there, where for landed property, the Residential Property Act applies, whereby foreigners cannot own or inherit. And of course, the land dealings unit will give some time for you to disengage from that inheritance, to sell away the shares to someone else who qualifies as a Singapore citizen to inherit the landed property.
So on the point about leaving the property that has still got some mortgage attached to these properties, it could also be commercial properties that have got outstanding loans on it. In those cases, I'll have to work with a financial planner like Ethan to see whether their insurance, whether it's from running their business where they may have purchased keyman insurance, some of these insurance payouts could be first applied to wiping out the liabilities.
Yeah, certainly. So when you make the will and you want to give away some property, then you need to be very clear whether the beneficiary takes it as it is, or if it is encumbered with some kind of a loan, whether that loan is to be discharged from other estate that you leave behind. Maybe you have monies in a bank account, or perhaps an insurance policy that is taken up to pay off such liabilities is already designated to do that job. These are things that you want to state so in a will.
All this succession planning is very critical to maintain the harmony within the family. If you have only one property but 2 children or 3 children, how do you plan to equalize the assets that you're going to pass to your next generation? Things get more complicated. Even if you have 2 properties in Singapore, 2 children, but it could be in different location. One may want Orchard, the other one may want Marina area. How do you equalize it? But a lot of our second generation, they are actually going overseas to study. And there's a tendency for parents to, okay, if my kid is going to London, I'll buy an apartment in London. If my kid is in Australia, I'll buy a property in Australia. And this complicates matter. And that's exactly what my family faced when the family had a few properties, one in London, one in Australia, in Malaysia, in Singapore. And they only have a will, and they use a will for every jurisdiction. Thankfully, they are all within a Commonwealth country, so we can get the will sealed. But that's still a lot of work, a lot of effort. And that's where the expertise of Precepts will come in to help the family advise on, hey, properties all over the world, how do you keep things equal? So again, there's a lot of topic that needs to be discussed when it comes to this kind of succession planning.
Yeah.
And you're also open to different laws, right? I mean, if you've got properties in different markets, the laws of those countries would also apply to the will, wouldn't it?
Yeah, certainly. Like if you talk about the United Kingdom, if a Singaporean died owning a property in London, he may not be aware, but there is going to be very significant inheritance taxes that has to be paid, up to 40% of the net values of the properties left behind in United Kingdom. Same goes with places like in the USA, and also in quite a number of countries in continental Europe as well.
There's one layer down, which is at this point in time, who is managing your London property? You are the one who has been in contact with your property manager, with your tax accountant for the annual tax filings. You know who is the tenant because you signed the document. Tomorrow you are not here. Does your family have the contacts? Do they even know the actual address of that £5 million house that you bought in London? And then who's managing it? Who's the accountant? Who's the lawyer? And then subsequently, the operational issues of producing the death certificate and the will there to then get the property title transferred to the correct beneficiaries.
It's very true. Sometimes for some of the very wealthy clients, they have been buying properties all over the world, and they don't really take stock of it. And the family members may actually be pleasantly surprised when they discover that the parent had some assets here and there which they never knew of. It's a bonus. But what if no one knew about the demise of the owner in some far-flung jurisdiction whereby the tenant even realizes that the owner had died and they stop paying rent altogether. So these things could really happen as well.
Yeah. There's a question that is following up on the UK property. It's about whether insurance can be used to offset the estate duty in an overseas property. Can you just buy an insurance policy for that?
Yeah, I would certainly encourage that to address the potential liability. There's a threshold amount whereby there is no inheritance taxes. The figure is £325,000. So anything above that is going to be payable at the rate of 40%. So work out the math, and it's much easier to have an insurance term policy that takes care of the liability than for the family to scramble for some money. Yeah.
That's based on valuation.
Yeah, a valuation would certainly have to be taken, because if you're going to have that property pass on to your beneficiary, then you will need the probate to be taken out in the English courts to enable the executor and trustee to transfer the property to the beneficiary. But before that transfer takes place, all the liabilities, the inheritance taxes, will have to be cleared off.
He's asking about other types of assets, such as shares in overseas companies where there is a death tax. Will the trust still have to pay this tax? Will a trust be able to manage all the assets?
I had the simple understanding in the past that maybe if upon our demise, everything gets willed into a trust and there's no transfer stamp duty in that action, and then subsequently the trust survives for another 99 or 100 years, and so there won't be another layer of potential inheritance tax for the next 100 years. So that was my simplistic thinking for quite a while.
Okay, let's if we're talking about a foreign company, then the ordinary principle is that the situs would be dependent on where the company is incorporated. So if you talk about, let's say, people who use a lot of British Virgin Islands companies, right? The situs of the shares would be in the BVI. In a BVI, there are no inheritance taxes, so you don't have to worry about that. However, you probably need to take out a probate in the BVI courts to get the shares of the BVI company transferred to your beneficiary. Okay, but if you own an English company and a company that is incorporated in the United Kingdom, right? And the United Kingdom has inheritance taxes. So just like the property in London, there will be an attributable inheritance taxes for the shares of the English company to be transferred to your beneficiary. So your executor and trustee not only would need to clear off the liabilities on the London property, but also to pay the appropriate inheritance taxes on the transfer of the shares of the English company. And the same also goes actually for any movable property in the United Kingdom. For example, if you own a bank account in Barclays in London and leave behind £1 million in a bank account, that is also subject to inheritance taxes, the UK inheritance taxes, right? So, you know, there are plenty of things to navigate. And back to what Yong mentioned about trust. Yes, in the English law, they have also been plugging at potential loopholes. So there is a general rule that if you gift away your assets out of your estate, then it will not be subject to any form of inheritance taxes because it's no longer part of your property, so long as you didn't, it crosses a 7-year mark, right? And then what happened was that people transferred assets into English trusts and thought that they would have gotten away. But there is also rules that came in over the years that required trusts to be valued every 7 years. And then there is a tax accordingly as well. You know, so it's a bit of a game in some ways whereby wealthy owners would have to look out for changes in the law and react accordingly, and potentially look at other jurisdictions where they move the monies. And Singapore is certainly a jurisdiction whereby we are promoting ourselves as a wealth management center.
What situations like COVID and what that has done to the government's coffers possibly impact this sort of taxes again? Would you see a potential change in taxes taking place with regard to your estate and inheritance?
So Yong, you may want to comment more on the real estate, that is prices which are running away.
If it is about a cooling measure, then yeah, more stamp duty or more loan restrictions could come in. But where it refers to estate duties and the transfer, actually maybe over the next 12 months, we might see a lot more than usual estate type of transfers, because with the outbreak in Malaysia, Indonesia, I'm already hearing from my friends whose relatives unexpectedly passed away a little bit younger than they were planning to. So relatives or a colleague passing away at 55 or at 60, and the family is actually now, they are in the process of transferring the wealth. They're waiting for the probate now in Jakarta. Okay. And because of the COVID situation. And many of these families actually have financial planners serving them from Singapore. They have got bank accounts in Singapore, and they may have 1 or 2 properties in Singapore as well. So for the next 12 months, I think we might see that this area of services between financial planners, private bankers, real estate agents, and trust managers, I think this area of work demand should increase due to the virus.
And you're saying most of that will be transferred to Singapore?
No idea. It depends on the next generation and what the next generation plans to do with. But I'm saying that it is going to be an unexpectedly high number, a sudden jump in the demand for such work.
Yong is absolutely right. In fact, over the last 6 months, I think with this COVID pandemic, families are spending more time together, and they start to think, the parents start to think about the next generation. There's more opportunity for conversation, because myself and my peers have been reviewing letter of wishes for trust that is set up by our clients, or it could be just reviewing the simple will. And honestly, I was very surprised. A will or a letter of wishes that was drafted 3 years ago, now if you go through the same letter of wishes or the will, things change tremendously, and it's only in 3 years, because prior to that, I thought that you could just leave it there for 5 years, 7 years, and then review it again. But I'm so wrong. I think now there's a need to reassess the situation because the tax regime has changed, COVID has changed things, and the next generation are growing up.
The foreigners, because of distance and inability to communicate so well, I think they are on the verge of returning again. And I, of course, would think that foremost in our minds would be some form of diversification of their risk in the different territories where they operate, whereby they could see that it's no longer the same. Where the familiarity of where they operate from might have been doing so well for them, but the pandemic has shown that there are a need to really, redeploy their resources as well. And alongside, not only just looking at their businesses, but looking at their wealth sources and even people, right? Should they have their children back in the home country, or should the children be moving around elsewhere in other locations? That's also part of diversification of the human resources of the family, really.
So a lot of these examples have been about wealthy families with means. How about the more average family, which may have just an HDB flat and maybe some money, not so many properties littered around the island or anywhere else in the world? What do they do? I mean, what should they do when it comes to planning their estate?
I'm advocating strongly that the HDB people do consider early as well their wealth transfer needs, because HDB is a restricted, has got restricted ownership. If your child has done well in his studies, now converting into American citizenship, you can't allow your son to inherit. I mean, HDB wouldn't allow your son to be a beneficiary and have his name on your HDB flat. So plus the fact that HDB dwellers amongst us makes up 80% of Singapore residents, right? So, but many of them think that no worry, when I am gone, it will just go to my loved ones. HDB will take care of it. But that's the issue. Your 3 beneficiaries or your 2 beneficiaries, each one may already have their own HDB or their own private apartments, and it is not convenient for them to receive it. And so then they and their spouses would have to get into a discussion about, should we sell it, or is there sentimental value attached to it? Write up a will, be very clear. The easiest thing to do actually should be sell it and then distribute the cash.
But you also need to do the nomination with CPF for CPF funds, right?
Yeah, that's an area which has really come to fore in the more recent years, whereby the CPF board has been putting a lot of media advertisements telling account holders that they can even voluntarily put in more money so that there is a higher annuity when they turn 65 with the CPF life. So it's not going to be unusual for an average account holder to be leaving behind at age 65, $200,000, $300,000, $400,000. And interestingly enough, yesterday's newspapers, they talked about a new scheme run by DBS Bank, whereby they could give a loan on the private home that is left behind, that the elderly couple may be living in. You have to be 65 and above to do that. So it's like a reverse mortgage. But the difference is that instead of giving you the money, they will top up your CPF account. So if you wanted the maximum payout and you were short by like $150,000 and you had equity in your private residence, you could go to DBS and say that, okay, lend me the $150,000. They will then top up your CPF account. And there you are. At age 65, you will then get your maximum annuity payout. So things like that, we see more and more people looking at the CPF nomination and finding that they're going to be potentially leaving quite a lot of money to a beneficiary who might be too young to receive the $200,000-300,000, or if they nominated their spouses to receive the $200,000 or $300,000, the spouses may be just as equally as old and potentially vulnerable when they receive it. So there are all these things to be looked at. So for mass affluent families, more modest families, even HDB dwellers, we are finding that when they start to aggregate the channels of money that could flow from the CPF side, the insurance policy payout should they die, from the investments that they hold with some financial institutions, their private residence and all that, it does aggregate to a fairly tidy sum, potentially several $1 million as well. And certainly that's, to us, a candidate that needs to engage in some form of holistic estate planning.
On the point about CPF and nomination, Chiwi, your company is coming up with a new product that I'm interested to subscribe to, nominating my CPF into a trust directly, should anything happen to me. Can you explain a little bit about that?
Yeah, so like what we said, people are going to be leaving quite a bit of money in the CPF accounts. The fact is that you cannot will away your CPF monies. You have to do it by way of the CPF nomination. The CPF board has done a marvelous job by facilitating a means to do it digitally. And we have come up with a digital trust solution to allow people who may want the monies to be nominated into a trust. And the trustee could be someone they want to appoint as the executor and trustee of their will. So the same person who is the executor and trustee of the will may also be appointed as a trustee to receive the CPF monies should they pass on.
What's the benefit in doing that, Chiwi?
Well, it's for protection of the money. So, I mean, there was this case whereby the account holder who had died, she nominated her sister to be the nominee of the CPF monies. But what happened was that when the account holder died, the sister was undischarged bankrupt. So the monies, which was about $100,000, instead of going to benefit the sister, instead went to settle the sister's creditors, which is ironic because you know, and I know that our CPF monies are safeguarded during our lifetime from any bankruptcy attack, right? Your HDB home, your CPF monies, during your lifetime, if you were foolish enough to get into a problem and you were sued to your last dollar, they could take everything from you, from your private banking accounts and all that, but they couldn't touch your HDB flat or your CPF monies. But in this case, what happened was that the moment the account holder died, all the money that she left behind became utilized for the settlement of the sister's creditors. But if you have put money into a trust, instead of going into the direct hands of the sister, then it will have been protected.
Yeah, but then the sister will still not receive it, right?
Well, we can always take the $100,000 as a trustee and give the money in small bits to the sister for her own maintenance.
There's always this myth that, or rather this belief that trust is only for the rich and the wealthy. So I think if Precepts has something like this is really targeting a sweet spot for people who want to do more than just having a simple will, but without going to the trustee level. It's somewhere in between. So I think that's a very, very interesting piece of development you have over there.
Yeah, I mean, every estate, you got to look at the total value, what you're going to leave behind. And there are possibilities of creating testamentary trust as part of your will making. And there's also other structures that we put up as solutions, for example, a standby trust, structures which only get activated upon death, for example. So, you know, when you go to some of the other bank trustees, for example, you need to put in a few $1 million to get the trust started. But with a lot of families, they like the idea of a trust, but they don't necessarily need the trust to get started while they are still well and able-bodied mentally as well to handle their own money and enjoy their own money. But they need the trust, or they like the idea of trust as a family fund or reserve for the rainy day. So those things, yeah. So depending on the client, there are all these whole suite of different kind of solutions that could be worked into for their benefit.
All this talk so far have been about families, right? Handing money to the next generation. What happens in the case of the DINKs, the double income, no kids, who are sitting on some money? What should they do if they don't have anybody to hand it off to? I mean, besides family, of course, but if they don't even have that.
We have encountered our fair share of single people. And what we have seen is that usually they want to give it to their nearest relatives, for example, their nephews and nieces, but they also want to set aside some money to give towards some charitable organizations. Yeah, and you know, we have a big landscape of charitable organizations catering to different aspects, from the poverty to enrichment for orphanages and all that. So
the next trend might be for sustainability causes, saving Mother Earth sort of causes as well.
Yeah. Certainly. Yeah. And we do have some clients who actually set up charitable trusts as opposed to a family trust whereby the benefits go to the family members. In a charitable trust, the monies are designated towards charitable objectives. And unlike the private trust, which I had said earlier, in Singapore current law, you can only have it for up to 100 years. Charitable trust can be for perpetuity, which reminds me, Kanan, of what we discussed 2 weeks ago about a charitable trust that I had administered, where an Englishman by the name of Henry Bolter had died in the 1950s, leaving a very small fund of probably around $80,000 back in 1950 or something. But today, that fund is still running strong, valued several $1 million, and still doing its charitable good by giving away the income towards charitable objectives annually, and yet the capital is still growing pretty well.
Okay.
Speaking about all these charitable trusts, like one of the aspects that we do for our family is that we look into the philanthropic aspect. Giving today is not as simple as just give the money and hands off, because there's actually a very clear framework and thought process ranging from what type of charity does the family want to support. This is something that the patriarch should actually direct the family when he is still alive. And then it also goes to things like, how do you measure the impact? You know, if you put in 50,000 or 100,000, you don't want it to just trickle down until that the final beneficiaries only get a percentage of it. There is this thing called measuring the impact of your charitable efforts. So there are professionals out there whom we work with to craft out a charitable strategy that suits the family. So that is what we do for high net worth individuals, or even the mass affluent. Nowadays, it's so common to think through their giving strategy.
One of the things that wealthy owners may do is to get the children to be involved more in the charity. And
Right.
Someone was telling me running a charity is, let's say, not in Singapore, but let's say in a place like Cambodia, it's very good training for the young, successor. Because when you run a charity in those places, you have to be very street smart. You have to be very careful with where the resources are allocated towards, and to account for this and that. And it's better than MBA trading, according to one of my friends who run a charity in Cambodia. Better than MBA.
Great. Gentlemen, thank you for all those various viewpoints. I think whoever's coming in would have learned a fair few things to consider when they are planning their estate, depending on their circumstances. And as Chiwi, as you said, you know, managing a charity in Cambodia gives you the smarts as well. So that's more than just giving you the money, but giving you the opportunity to develop your thinking and your strategic mind. So the opportunity, of course, is to continue spreading whatever you can with whatever you have.